Good morning. Welcome back to On the Brink. I'm Nick Carter. This is the Mining Mini-Series. This episode is brought to you by Compass Mining. More on them later in the episode. Today is a big day. The House Energy and Commerce Committee is hosting a hearing on proof-of-work mining. I think we all know it's going to be pretty tough listening for anyone with a passing familiarity of proof-of-work, which you all should have at this point, given the extended Mining Mini-Series. Today, maybe instead of the House hearing, you can tune into this episode. We host Daniel Roberts, the co-founder and CEO of Iris Energy, a publicly traded Bitcoin miner with a strong focus on sustainable energy. I found this to be a very interesting conversation. Iris has a pretty different approach from a lot of other Bitcoin miners, and in particular, I found their case study around mining with energy resources that were left stranded after the pulp and paper industry left British Columbia to be just fascinating. If you're at all interested in what truly sustainable Bitcoin mining can look like, I think this conversation is a great place to start. Let's dive right into it.
Brought down by bad mortgage investments, Lehman, which has 25,000 employees, will be liquidated.
The federal government loans American International Group, AIG, $85 billion.
This is a different kind of market, and the Fed is asleep.
The federal government is stepping in to stabilize Fannie Mae and Freddie Mac, the two mortgage giants that have been threatened by the housing crisis.
The Bank of England has pumped £75 billion more into Britain's ailing economy with a new round of quantitative easing.
You print a couple $1 trillion, and all of a sudden, people start to worry. So out of this worry, we have something called the Bitcoin.
I have the privilege of sitting down with Daniel Roberts, the co-founder and CEO of Iris Energy, which is a fully renewable Bitcoin miner. They've recently gone public. They've been on my radar for a little while. Very excited. Thank you for joining us today.
Thanks, Nick. Pleasure to join.
Awesome. So I guess, you have a pretty interesting background. So tell us a little bit about yourself and then how you came to sort of find the opportunity in Bitcoin mining.
Yeah, so I think the journey with Bitcoin probably dates back to late 2013. I was one of those people that bought in as the price was rocketing towards $1,000, and it came off and halved in the year or two later, and I sold it all and thought this is nonsense, and kind of disappeared for a little while. I then went into the Ethereum ICO and did well out of that. But it was around 2017 that it really hit Will and I around what Bitcoin was, the monetary asset that it is. And I guess the benefit today is the quality of literature is fantastic relative to what has been the case over the last 10, 13 years. And at that point, we kind of just reached this point where we said, what, Bitcoin's here to stay. With its increasing scarcity characteristics every 4 years to the ultimate cap of 21 million, how does this not create a positive flywheel around the store of value, the network effect, the longer it survives, the lower the perceived risk, et cetera, et cetera? And as you know, no supply response, unlike other commodities. So I think that was the Bitcoin lens, and from that drops out, I guess, the view on mining, which we can come to, but a little bit about Will and I and our more professional backgrounds. So ex-PricewaterhouseCoopers, Macquarie, developing infrastructure, renewable energy projects across Europe and Australia, and then was involved in setting up an infrastructure funds management business in Sydney about a decade ago. Right place, right time. We grew to around 8 billion in assets under management. So this was on behalf of pension funds, insurance funds, so ports, airports, wind farms, solar farms, etc. I stepped back from my executive role there about 3.5 years ago, and at that point joined up with Will to form Iris, and Will's background was also in banking and commodity finance. And I think the opportunity we saw in Bitcoin was linked to that view of Bitcoin hanging around and likely escalating in value, and the need to direct all this real-world energy and data center infrastructure towards securing it.
Gotcha. And you mentioned high quality literature supporting Bitcoin, which I find interesting. I also perceive that. Are there particular resources that you read that really, changed your mind or made you take another look at it?
I think early on, the literature that resonated with me was a combination of messages from Safedein's book, The Bitcoin Standard, obviously very well known now. Nick Szabo, a lot of his writings resonated. The Sovereign Individual, extremely prophetic, as we know. And then I think it kicks off a bit of a cascade down the rabbit hole of just learning a little bit more around what money is. And we've grown up in a world where US dollars, Australian dollars for us, we just accept as money. And when you start challenging some of those assumptions, it leads you down a path which is fascinating, as we know.
So you position yourself as a sustainable Bitcoin miner. What does that sort of mean to you?
Yeah, so I think maybe in terms of stepping back a second and why sustainability is really important. And I think this is one thing that's really starting to hit the industry head on, which is this dislocation between the real world and the digital world. And as a miner, your revenue line is fundamentally the price of Bitcoin, right? Every 10 minutes, there's the amount of Bitcoin available to the miners. But the only way to get a piece of that digital pie is to build out this real-world energy infrastructure, get access to capital, access to chips, etc. And what we've hit over the last 12 months or so is this inflection point where the real world is really struggling and can no longer keep pace with the digital world. Back when Bitcoin was small, it could. When there was, say, 50 megawatts of power capacity securing the network, Bitcoin goes on one of its 5-10x runs. The world can find a few hundred megawatts worth of power, chips, capital, plug those computers in, the hash rate can catch up to the price. But we saw firsthand, even in 2017, the price peaked in December. It wasn't until the following August, so 9 months later, that the hash rate caught up to the price. And that was after the price fell 70%. You then fast forward to today, or go to late last year, right? There's 8 gigawatts, give or take, securing the Bitcoin network. Bitcoin goes on another 5x run from 10 grand to 50 grand. All of a sudden, we're in this completely different paradigm. To try and bring online enough mining capacity to normalize those historic returns on capital, you now need 30 gigawatts of power. The entire global data center industry is something like 23. You need $70 billion of capital. And yes, institutions are here, institutions are coming, etc., but it's still early. I think the listed market might have raised 3 or 4 billion in the last 12, 18 months. And then finally, even if you get that power, you get the capital, you're still waiting 4, 5, 6 years of full manufacturing production of these specialized chips out of Asia in the middle of a semiconductor shortage where people literally can't build cars. So what this has created is this enormous dislocation between the real world's ability to build out energy and data center infrastructure to keep pace with this digital exponential asset. And off the back of that, you can start seeing those numbers start driving, well, hang on, there's going to be a lot of power potentially consumed to support this network by virtue of those economic incentives. And then the sustainability argument starts popping up around, well, how do you sustainably procure that power? And I think for us, very early on, we've sought to build out, and you would have seen from our CVs and the management team, we've got about 45 people across North America and Australia, all traditional energy infrastructure, data centers, renewables. And for us, building out an institutional quality platform at its heart has been about managing risk. And sustainability of operations is the key to that. And we never want to be accused of pushing up power prices to mums and dads, never want to be accused of taking power away from other industries. So for us, coming back to your question directly, our energy strategy from day one has been really clear. Not only will we target renewable energy, we will only enter a market where we're solving a problem, actually doing a social good. And yes, we know we've got to tick the ESG boxes for institutions, but this is fundamentally so much deeper. It's around winning the hearts and minds of the local communities and areas in which you operate. So we can go to a little bit more of how we do that specifically in markets like British Columbia and Texas, but it's really those parameters, not just renewables, but also making sure that we're integrating into energy markets and delivering positive externalities with our business.
Yeah, it's interesting because I think you're probably one of the first mining companies I've encountered where sustainability is sort of impregnated into the DNA of the company as opposed to an afterthought or, oh, we have this exposure, we have this regulatory or political exposure, we have to tackle it in some way. But I mean, certainly, I directly perceive the risks that miners face from national policymakers, but also local communities, people that are aggrieved by the presence of Bitcoin miners. There's abundant examples. I mean, wherever you care to look. And so I think that's very sensible. Now, in terms of how you go about, determining where to locate your operations, I guess you start with the whole globe, right? Because there's a whole world's worth of opportunity there. How do you then narrow it down to the jurisdictions where you choose to operate?
Yeah, it's a good question, and obviously it took a lot of time flying around the world early on and desktop research, etc. We only wanted to focus on institutionally bankable jurisdictions, so markets like North America, some markets in Asia, Europe, etc. And very quickly settled on North America as a good place to do business for a few reasons. Fundamentally, we're looking for low-cost excess renewables. So where are markets that had an overbuild of renewables? Where was the climate manageable for our operations, such that the need to power cooling, etc., wasn't prohibitive to the economics? And we stumbled across an opportunity in British Columbia, and at that point merged or acquired another business called PodTech that was founded by two Brians there. And it's probably worth mentioning them briefly. Brian Fair, Canadian industrialist, built a large construction business, has the Order of British Columbia for his work in regional communities. And Brian Fry co-founded a company called Rackforce in the early 2000s, which actually grew to be one of Canada's largest cloud computing data center platforms before he sold out about 5 years ago as well. So two very high quality individuals that joined up with Iris. And the opportunity in British Columbia from a power market perspective was and is they have a massive oversupply of hydro. They're still commissioning large scale hydro in the north of the province, Site C, in the face of decline in manufacturing and industrial load. So over the last decade, the pulp and paper industry has been decimated there. And what this does in a regulated market where you've got an oversupply of power, somewhat counterintuitively, power prices have upwards pressure. It's not like a free market, like a deregulated market like Texas, which we'll come to. Basically, under the regulated model, someone needs to pay the utility such that that utility can earn a return on all the investment it's made in infrastructure and generation. So if you've got a lower number of users, then the cost of that generation infrastructure needs to be spread across them. So we're coming into these local communities, often leveraging sunk capex in electrical infrastructure, etc., partnering with local towns and communities that have seen, the decimation of economic industry in those towns, and providing BC Hydro, the local utility, with an alternative revenue line such that they don't need to go and charge mums and dads and other industries that money to recover their capex instead. So it's a really good service that we're providing there, and there's a substantial amount of sites and opportunities. We've got 3 under construction or operation and a number of other sites that we're actively working on as well.
So just so I understand, the grid in British Columbia was constructed with the assumption that there would be this industrial consumer of power, in part stemming from the pulp and paper industry, which is a electrically intensive business. And as that ebbed away, the power companies were faced with the prospect of having to raise prices for consumers. And now having Bitcoin mining as a stopgap there actually inhibits their requirement that they might have to actually raise residential power prices.
That's exactly right. And it's a bit of a perfect storm, right? Because they've been hit on both the supply side and the demand side. So on the supply side, they've got new generation coming online from facilities that are now becoming operational after the investment decision was made many, many years ago, combined with the decimation of demand from the closure of the local pulp and paper industry, creating this oversupply of power.
And what, give me an idea of kind of the scale of sort of the excess energy here. How material is that?
Look, I haven't got the exact numbers, but our understanding, at least anecdotally, is well over a gigawatt of excess power. in the province. And it's one of those things we need to be very careful of as well. Like, we need to leave room for other energy intensive industry. Electric vehicles are coming, hydrogen, green hydrogen, certainly a large push in many countries around the world. So it's not like we want to go in and steal every available megawatt hour of excess power to the detriment of future industry, but there's certainly a role that we feel that we're playing that's valuable today and will continue to do so.
Right, and this is something I think about a lot is, Bitcoin isn't the only sort of quote unquote location agnostic industry in the world that draws a lot of power. Like, historically you had aluminum smelting playing kind of a similar role, and hydrogen production, desalination, to a certain extent, these are, partially location agnostic. So do you see a model where, you'd move beyond just mining Bitcoin to other sort of location agnostic, energy intensive industries, or do you see yourself as primarily a Bitcoin miner for the long term?
We certainly have that optionality, and that goes to the heart of, I guess, our business model, which is building out a real asset platform. So we don't do short-term contracts. We don't do hosting arrangements. We don't give our computers to other people to manage on our behalf, and I can get into why that's the case. So we own our land. We own our infrastructure. We own the substations, the power contracts, our own proprietary data centers that seem to be driving some considerable operation efficiency versus the shipping containers and other warehouse models that you see out there. And I guess that ownership of all the real assets certainly gives you that optionality to push into other industries. And remember, like, the team's built out gigawatts of renewable energy, data centers, and other infrastructure assets. So the pivot from a management perspective wouldn't be difficult. But today, it's very clear. And in fact, we signed an MOU with Dell Computing almost 2 years ago to start bringing out some of their customers and hardware to our first site in Canal Flats, because high performance computing, it's real, right? Artificial intelligence, data analytics, machine learning, oil and gas reservoir analysis, all these applications that don't need the bells and whistles of capital city data centers. But ultimately, the opportunity cost of time, capital, resources meant that Bitcoin mining was the focus. I think in terms of the geographic flexibility, your analogy to aluminium smelting is a really good one, and Bitcoin has been described over time as modern day aluminium smelting. I think the key difference is, even with hydrogen, is when you're monetizing it into a real world asset, you've got a lot of logistics considerations. So hydrogen, you either need to truck the hydrogen from the site, or you need to be close to a pipeline and then commingle it with natural gas and deal with that. And look, it's all possible, right? But it's additional considerations. Aluminium smelting, obviously significantly more challenges around logistics. But that was, an industry that anecdotally was born from leveraging excess power in different markets. But when you're monetizing the power into this digital asset that can be broadcast off, a 4G signal, it gives you incredibly more significant geographic flexibility because of that. And then on the power consumption side, you've also got enhanced flexibility versus some of these other use cases, because ultimately, while these computers are on, they're generating Bitcoin. While they're off, they're not. There's no customer contracts, no uptime guarantees, no consequential loss. When the power market changes, particularly in these intermittent renewables markets where you see those power prices peak, you can remotely throttle down the frequency of these chips, dynamically reduce your energy consumption, and then a few hours later just ramp it back up. And we haven't come across any other end loads that have that same flexibility, and that seems to be a lot of the value proposition that markets, governments, and utilities are seeing in Bitcoin miners. In fact, Australia, down under locally, late last year, actually proposed a tax subsidy. It hasn't been passed yet to my knowledge, but a tax subsidy for Bitcoin miners that use renewable energy, recognizing the benefits that it can give to these networks.
Right. And so I think these are incredibly important points that you're making here. And so I'll just try to summarize. So on the one hand, if you compare Bitcoin to other somewhat location agnostic physical industries, Bitcoin is truly location agnostic because you can bring it to market from anywhere on Earth. So once you have the commodity, you can, digitally transport it, which is not the case with your other somewhat semi-location agnostic physical industries. And then comparing Bitcoin to digital industry, other computational industrial loads like regular old data centers, they're less interruptible. Bitcoin is much more interruptible because a data center will have an SLA and it'll have an uptime requirement. And so it compares favorably with other kind of digital computational industries. So I share your intuition. I've never come across an industry which is so gentle, I guess, in terms of fitting into the grid and accommodating energy, which is might be intermittent and is also stranded. So you mentioned British Columbia. What are other jurisdictions where you are sort of operational or plan to operationalize?
So we've got a number of projects under development in Texas and one down in Australia. And in Texas, the market there, particularly West Texas, up into the Panhandle. I know you've written a lot about it as well, but an enormous amount of constrained renewables generation, the opportunity to provide those demand response and ancillary market services. But essentially, from day one, we've been looking to build out this global platform. Like any good portfolio, spread your risk across projects, grid connections, jurisdictions, etc. Like one of the greatest opportunities is to monetize into this digital exponential asset where there's the real world constraints around bringing online that additional mining capacity. But that brings with it, social licenses to operate, social risk, political risk, etc. And we've just sought to manage those risks from day one, and geographic diversification is a really big part of that.
So do you have communication with policymakers? Do you try and communicate what it is that you're doing and explain some of the positive externalities potentially of Bitcoin mining?
Look, we haven't gone into kind of the policy and the political level. We've chosen more to deal with it at a local energy market level. So dealing with the energy retailers, the utilities, the network owners of the infrastructure, so the transmission and distribution line, and really explain to them commercially what the opportunity is for us to help them. And I think by bringing them on board and delivering those positive externalities and integrating into those energy markets, if and when it does become a political issue, and to date we haven't seen it in the markets that we've operated, perhaps because we've chosen those markets sensibly. Then if that question is ever raised, then I would like to think that we've got a number of stakeholders that are going to be very favourable and positive towards Bitcoin miners in that jurisdiction by virtue of what we're doing.
This episode is brought to you by Compass Mining. Compass Mining is the world's first and largest online marketplace for Bitcoin mining hardware, hosting, and ASIC reselling. Bitcoin mining is only getting bigger, and so is Compass Mining. Compass is adding 280 megawatts worth of hosting capacity next year, with more to come. That's over 6 times Compass's current hosting capacity, meaning more people can mine Bitcoin. With Compass, anyone can mine Bitcoin. Start mining your own Bitcoin by visiting compassmining.io today. So regarding Texas, we certainly covered it on a few episodes of the mining mini-series. It does seem to be the epicenter, at least in the U.S., of mining. If you just look at the wind and solar resources out in West Texas, they're abundant. The interconnection queue has tens and tens of gigawatts of additional wind and solar, which is kind of astonishing, also given the fact that there's transmission bottlenecks today. Can you tell us a bit more about the models? I know, certain miners are looking at co-locating, behind the meter, so to speak. Others are operational on the grid and they're active in these ancillary services markets. What are the models that you're contemplating down in Texas?
Yeah, and look, Texas isn't an isolated example. There's a number of other examples of markets around the world where you've seen the build out of intermittent wind and solar, largely driven through government incentives and subsidies. And sometimes, particularly in these Western markets, combined with the decline in manufacturing demand and industry, creating, again, this perfect storm. And then you overlay the build out of residential rooftop PV, reducing net retail demand. There's a need in many of these markets to bring back energy intensive industry and also solve the system flexibility issues, the time of day productions, the lower resilience in the network. And yes, people are installing large lithium ion batteries, building out gas-fired peaking power stations, but Bitcoin mining can solve those issues on the demand side. And this isn't the narrative around co-locating next to a wind farm and a solar farm and just taking power from that asset. Firstly, locating behind the meter is risky. If you're putting your destiny in other people's hands, all of a sudden you're taking, as an investor, and a team, you're taking risk on Bitcoin mining, and then you're taking risk on a wind farm. And, their downtime, their maintenance, their their access to the grid, contractual disputes, etc. So we've always preferred to have direct access to the grid and avoid those risks. But from an energy perspective, it's all about being grid connected. And it's understanding that these deregulated markets like Texas and Australia are a melting pot of different generation sources, wind, solar, some legacy fossil fuels, and different demand sources. And with the intermittent nature of wind and solar, it creates more variability in the power market, where it's only a very small number of time intervals each year where the power market is not in equilibrium and supply is well below demand. In Texas, the big freeze is well publicized earlier this year. That's an example. So this is not a narrative of just taking wind from a specific solar farm. It's about being connected into that grid and saying that 1%, that 2% a year, when the power market can't cope, instead of building a battery, instead of building a large-scale gas-fired power station, just have some Bitcoin mining in your demand mix that can throttle their chips down, give that power back to the market, back to mums and dads, back to other industry, and then a couple of hours later, when the market normalizes, just turn them back up again.
Right. And, the pushback I hear is, having a source of demand that turns itself off strategically doesn't solve the problem of undersupply. But I guess the idea is that the Bitcoin miner is monetizing these renewable assets by virtue of its presence on the grid. So it's making those assets more viable. So that as an economic pressure, which improves their economics, and maybe it's an incentive for additional build out, and it just so happens to have this additional positive effect where it can throttle itself down during a time of crisis.
That's exactly right. But remember, a lot of these markets don't have an undersupply issue. They've got an oversupply issue. And I think your presentation a little while ago actually highlighted some numbers, circa 32 gigawatts of wind and solar in West Texas up into the Panhandle, and only like 12 gigawatts of transmission line capacity. We're seeing it in other markets as well. Some of this power, not only is it receiving negative power pricing, so they're having to pay to export that power, often they're just spilling that power into the ground. Like they're not even exporting it into the network. So we're coming in there, underwriting these renewables, taking that power, giving them a revenue line and avoiding them having to pay to offload that power, and then overlaying the additional benefits of that flexibility in load to when power prices do peak and when there's excess demand, be able to switch down that load. And if you take it to the next level, if we as a globe want to further decarbonize, we're in this kind of conundrum at the moment where there's been a lot of tax incentives, government handouts, subsidies, etc., to encourage the build out of renewables. But the lack of market pricing for renewables in a lot of these markets is now inhibiting construction. So you talk about those tens of gigawatts in plan in Texas. Are they going to build where there's negative power pricings and no demand signal? And then you can't retire a lot of the legacy gas and coal because you don't have enough renewables to replace it. So you've got this chicken and the egg problem. So if Bitcoin mining can come in, provide that market-based price signal, then overlay the system flexibility issue to migrate the market back towards a market that it more resembled during the baseload era, then all of a sudden you can build more renewables and you can start looking to retire more of this legacy gas and coal.
So to the extent that, you have legacy thermal generation of energy in your energy mix, do you then try and procure credits or offsets in order to target your fully sustainable mandate, so to speak?
Yeah, look, we absolutely will. And it's been one of those things, Nick, where we've been focused more on just solving problems and delivering those positive externalities rather than dressing it up and describing us as level 1, level 2 greenhouse gas and carbon
Right.
neutral, et cetera, et cetera. Like, we will do it and we'll go and advertise it and tell the world how green and sustainable we are. But to date, over the last few years, it's really been about just fundamentally building out a business that's solving problems. And we're solving one problem, decarbonising the Bitcoin mining network, generating returns to our shareholders, securing the network further. And then the other problem is solving the energy market issues in these renewable energy markets that need more load to come into them.
So, correct me if I'm wrong. Iris is a part of the Bitcoin Mining Council. Am I right there?
We haven't joined to date in Texas. No.
What do you make of similar such initiatives to share data regarding the energy mix of Bitcoin miners and promote that data to an audience that might not really understand the nature of mining in the U.S.?
Look, I think anything that seeks to provide transparency, education in this space is fantastic. And as we know, crypto and more broadly is the master of narratives and misinformation. So the more quality literature and information we can be providing to the market, the better. So any organisations that are seeking to do that, we'd be very happy to talk with.
So we've seen really dramatic changes in the last year. I think it was in May that the crackdown began, May of 2021 in China, if I'm not misremembering. And that, eviscerated the Chinese hash rate. It's probably not zero, but certainly dramatically reduced. And we've seen all these capitalization events for, Western miners effectively. And, we've seen this exodus or this growth in hash rate in North American energy markets. So I think if I had to make a guess, I would say Bitcoin's hash rate has been decarbonized. Probably not fully, but to a significant extent, because you no longer have that coal in Inner Mongolia or Xinjiang. Kazakhstan has cracked down. Also, this hasn't been discussed as much, but they've cracked down on mining. That they're primarily coal. Of course, you have some residual markets that are higher carbon intensity, like Iran, where some Bitcoin mining occurs. But it seems to me that this reshuffling of hash rate towards the West has reduced the carbon intensity of, a unit of Bitcoin hash rate. What do you make of your peers in sort of the North American Bitcoin mining market? Do you feel that they have done a good job of finding low carbon energy sources?
Yeah, and look, anecdotally, I'll agree with everything you've just said. And you mentioned Iran. I can't recall if you mentioned Kazakhstan. I think they're potentially a large player these days and got a little bit of coal there. In terms of North America, I think it's a market that's still finding its feet, if I'm honest, including from an investor perspective. I mean, without naming names, like two of the largest or well-valued on a metric basis public miners use gas and coal. So right. Is the market really focused that much on sustainability? Yes, everyone dresses it up. Everyone's got their own narrative, and that's kind of human nature and life. But I think going forward, certainly the push seems to be very much green and sustainable. But what I would caution is, like, even if you go and use renewables, it's not enough. If you're using renewable energy but still taking that power away from mums and dads and other industry, if you're still using renewable energy and pushing market prices up by virtue of your energy consumption, look, it's a business model and you'll probably make money in the short term. And look, a lot of the other mining models are more focused on accumulating as much Bitcoin as they can in the short term and not thinking as much about the longer term, just dealing with that when it comes. But I think for us, it's really, we come from a world where we're used to looking at 20, 30-year financial models. And yes, modeling out Bitcoin over a 20, 30-year time frame is probably impossible at best. it does influence the way we think about our asset base and how we set up our business and our operations, etc., to build that long-term, multi-decade platform. And I think the market is now starting to accept that Bitcoin's here to stay. And if Bitcoin's here to stay, the need for mining capacity to secure it and the economic incentive is here to stay. And that's influenced a lot of the decisions we've made around how we've approached the sector.
So it's interesting because you, as far as I can tell, are being an excellent sort of corporate steward and taking very proactive steps to identify not only low carbon energy sources, but also I call them non-rival energy. So energy that's not competing with, in particular residential. But finding these somewhat stranded or special situation sources of energy that maybe aren't fully exploited, and yet that's not necessarily the case for all Bitcoin miners. And then as a consequence, it sort of brings an exposure on you, even though you did nothing wrong. I'm seeing this at the federal level in this country now, is questions around the Bitcoin mining industry. How do you think about political risk, not just locally, but at the federal level too?
Yeah, look, and I think the mining industry is evolving rapidly, right? Like, gone are the days of the manufacturers, front running the general public by mining on their own balance sheets, developing a more efficient chip 6 months later, selling the old stuff to the general public, rinse and repeat, etc. It's really turned into a capital markets and infrastructure game. So players that can, raise capital, deploy it into the infrastructure and deploy those computers. And with time horizons now starting to push out by virtue of people accepting that Bitcoin's here to stay. As a consequence, Bitcoin mining is here to stay. Jamming these computers into shipping containers that only work half the time and have shutdowns and overheating and breaking the computers. Like, everyone's starting to really challenge how they think about these business models. And you'll see more and more quality businesses come to market that have got experience in building out large scale infrastructure, data center and energy platforms to build upon that and move away from this kind of cottage industry that it was great and it was fit for purpose, time and place. Everyone will do it their own way, and ultimately, different business models will win out over time. How that then manifests in terms of political risk and interaction with governments and regulators, etc. I mean, I do find it a little bit amusing that Bitcoin gets so much attention. Right. There's been a few good anecdotes out there. Like, if people have an issue with negative externalities associated with power generation, then go and solve that. Don't penalize emerging technologies. And I think the issue is that if you don't see value in Bitcoin, then any energy directed towards securing it is going to come from a bias that it's a waste.
Even if the energy wasn't used otherwise, right?
Exactly. So it's a bit of an argument that you can't win in a way. Look, I think all we've got to continue to do is to not just focus on renewables, but also not pushing up power prices to mums and dads, not taking that power away. And one of the things that we'll look at, as soon as we can't find that excess power, we can't solve those problems in energy markets, we'll start considering building this stuff on balance sheet. The team cumulative has built out billions of dollars of renewable energy generation assets, wind, solar, etc., and moving towards even a net positive construct where we start self-generating more power than what we consume behind the meter for our own data center activities. Sell that excess power back into the grid, directly contribute to the decarbonisation of these networks. We're fortunate that we've got that capability in-house and that experience and that skill set. We don't need it today because there's a lot of other renewables that other people have built out that we can go and help today, but there's a lot of optionality in the business model longer term. And I think, just being able to articulate that, educate, the public, governments, etc., there are a lot of benefits associated with this business if people spend the time and understand it.
So one thing you mentioned at the start of the interview was what happens if the price of Bitcoin goes up a lot? And, historically it's done that. This is also something I hear all the time from I would say energy critics is like, well, what happens if the price of Bitcoin goes up tenfold, and now we have this ravenous demand for new energy as miners try and close the gap. They close the arbitrage. As the ecology of mining is such that margins want to go to zero, but of course there's impediments to doing that. So do you feel that the world has sufficient sort of stranded or non-rival energy such that Bitcoin can actually achieve its potential as a monetary good and not be too disruptive to sort of the global energy resources?
Yeah, no, it's a good question, and ultimately it comes down to economic incentives more than Bitcoin needs to use more and more energy to succeed as a store of value monetary asset. Like Bitcoin's security today is enormous, right? To
Right.
try and start tampering with transactions and as 51% attacks and censoring transactions, they're so overblown in terms of the risk of actually practically happening. And even if you wanted to try to overcome 8 gigawatts of power today is a phenomenal effort. So potentially we're well past that point today. So really it comes down to economic incentives. And every 10 minutes there's an amount of Bitcoin available to the miners. Multiply that by the current fiat price of Bitcoin, and you've got this global bounty. And if that's big enough, it will incentivize more miners to try and come online. They will try to buy the chips. They will try to find power that's sustainable. They will try to raise the capital to build out the infrastructure. And if less people are able to do that because Bitcoin is running too fast, too hard, and the real world can't keep pace, which is what we've been seeing, then the miners just make more money. It doesn't impact
Right.
the network and whether or not Bitcoin succeeds as a model. And to be honest, that's the heart of the opportunity that we saw 3.5 years ago. This asymmetry in the business model, the inability of the real world to keep pace with this digital exponential asset. It was possible when Bitcoin was small. Now Bitcoin is big, much harder.
But I guess to sort of simplify the question, I mean, so we're at maybe 8 to 10 gigawatts. Could we find an additional 20 gigawatts under your model, the philosophy that you laid out here? Do you think that exists?
Look, there's a lot in Texas to start with. There's a lot in other markets. There's some in British Columbia. There's others in other markets. I haven't sought to quantify exactly how much there is. I mean, we've got to keep in mind, right, that there are other constraints on using that power, namely the chips. How many chips are produced each year? Maybe a couple of gigawatts, 3 gigawatts worth of chips. Yes, that can change over a 3 to 5 year time period, but that puts a kind of a bound on the ability to use that power, even if you find it. And I think for us, rather than speculating on whether there's 10 gigawatts or 50 gigawatts of excess capacity today, there's an enormous opportunity for us to deploy the 15 exahash that we've got contracted. It requires around 500 megawatts, and then look to continue growing beyond that. The numbers are so small for the profits they're generating relative to the market size that sometimes you can get a bit overwhelmed in the macro and just say, well, let's focus here and now. What are the problems that we can solve? And we know that we've got a roadmap. If that excess power starts drying up, then just start going and building our own renewable energy generation and selling the excess power back into the grids and delivering services to the market that way.
Right. So regarding the ASIC market, a lot of people talk about this plateau in efficiency of ASICs. First of all, do you believe that's happening? And then secondly, does that change the business of mining at all?
Look, undoubtedly it's happening. For several years there, Bitcoin mining manufacturers were chasing the efficiency of traditional computing, right? And chasing down that efficiency curve. Today, they've now caught traditional computing. They're competing with the likes of Google and Amazon to procure 5 and 7 nanometer wafers from TSMC and Samsung. So a lot of that low-hanging fruit and early gains, undoubtedly. You look at the transition from CPUs to GPUs to the early ASICs. those efficiency gains, are they likely to be replicated now that the Bitcoin mining manufacturers have caught traditional computing? It seems pretty difficult. Are they going to continue to find efficiency gains? Of course. Like, the world doesn't stand still. It's not human nature. The economic incentives are high. They'll continue to work out how to iterate the current chips they've got, drive additional efficiencies, etc. But I think the biggest takeaway from the chip side is these chips are now lasting a lot longer. Even the S9s, the 16 nanometer chips that were released, 5.5 years ago, first industrial era ASICs, they're still making money above 10 cents a kilowatt hour.
Right.
So this narrative around chips only lasting 2 or 3 years, like, I think it's now well and truly been debunked and people are seeing it firsthand. If you put them in shipping containers, in old abandoned warehouses, you let them get dusty, overheat, yeah, sure, they won't last more than 2 to 3 years. But the chips themselves, they last for decades if you do look after them. And the stuff that you're buying today is, more than 3 times more efficient than those S9s. So again, you can see that industry starting to transition and move from a short-term Bitcoin grab out of every machine you can plug in anywhere towards, thinking about the long term. How do you manage your assets? How do you extract the most operating efficiency out of them? How do you look after them for the longer term?
So just to sum up here, I guess one of the remarkable things you told me in our prior conversation was that Iris doesn't really see itself as a vehicle to acquire as much Bitcoin as possible and to get long Bitcoin. You see yourself as in the business of mining Bitcoin, but you're not strictly seeking to hold on to it at the corporate level. Is that right?
Look, never say never, but like, our job in life is to generate as much value to shareholders as possible. And sitting here today, we have an enormous opportunity to become one of the leading and largest platforms in the industry. We've got binding contracts for over 15 exahash of mining capacity, at a price that was signed probably less than half the current market price. We've got sites and land secured for well over a gigawatt of power. We need about 500 megawatts to install that 15 exahash. We've raised a bit over $500 million to date, and through funding a little bit more through debt and reinvesting that profit, we can have 15 exahash online. So it seems like a very obvious capital allocation choice today. And if you step back, like, what value are we adding directly by holding Bitcoin? Like, our expertise is generating a return from real assets. That's our background. That's the game. And when we can reinvest the profits in building out additional mining capacity, looking to expand beyond that 15 exahash, when miners trade at a multiple of cost, you kind of have immediate value creation for your shareholders if you have the team and the platform to support doing that. I mean, for you, like, when you look at it, and if you've got a choice to distribute cash out to shareholders who can then buy Bitcoin and self-custody, or have the corporates hold that with a custodian like Coinbase or Gemini, I mean, what are your thoughts?
Yeah, I mean, I see the merit in certainly historically trying to accumulate as much Bitcoin as possible, whether it's by buying it on the open market or mining it below market price. But yeah, I think we share the same view. I see the industry maturing, and mining becoming much more a game of managing your costs and maintaining a healthy margin, as opposed to just being a pseudo, Bitcoin ETF, like a lot of the miners were.
And it does seem to be conflating business models slightly, and there's also a risk overlay as well. Like, life's good when Bitcoin's going up. You're making money on your P&L. You're making money on your balance sheet. But Bitcoin has a drawdown. You're now getting hit on your P&L. You're getting hit on your balance sheet. And then furthermore, if you've got a business model that's reliant on raising money to finance OPEX, let alone CAPEX, and you can't because we're in a bear market, then all of a sudden you're faced with the prospect of having to liquidate Bitcoin at the bottom, at the worst possible times.
We've seen it happen historically. So you become very pro-cyclical as a business. It certainly gives me pause. I'm encouraged to see, talk these more sort of mature business models. So I guess to sum up, any last word that you wanted to share? And also, how would you recommend that people sort of follow you personally and then at the corporate level?
No, I appreciate the opportunity to come on and have a discussion, Nick, and appreciate all the work you've done around the space as well. People can follow us. We're on Twitter. We're on LinkedIn. We're publishing our monthly reports to the market, providing updates on our operating capacity, as well as our development outlook and construction for delivery of the 15 exahash. But look, we're very positive on where the sector's going, the focus on sustainability and green, and I think it's just a matter of getting that message out there in a concise, well-educated forum for people to understand.
Well, this has been fantastic, Dan. Thanks so much for coming on today.